Hello, everyone. I hope all had a really great weekend and study break. Today I'm planning to start a new chapter, and on Wednesday we're gonna have the exam. The exam will be at 7 p.m. Let me just share the screen for you. I already shared the information with you, but let me just share it again. So the exam one information is available in the Moodle. For the details, you can just come here and see it. So it will be at 7 p.m. on 28th, the day after tomorrow. You've got 10 multiple choice and one open question. So in total, I'm planning to give you 1.5 hours. Questions will be, especially the multiple choice question, will be in sequential order, which means that you cannot return to the previous question. You have to solve the question and move to the next one. If you leave the empty one, it will be considered as a wrong selected question. So you have to be very careful about it. And for the responsible chapter, it's the capital budgeting. This is what you should take care of for the exam itself. And that's it, the information about the exam. So I'm planning to start a new chapter, which is right after the capital budgeting, we're coming up with the cost of capital. If you remember, so far we've been talking about cash flow projection and cash flow estimation. We learned many things, like we use different risk analysis instruments like scenario analysis, sensitivity analysis, Monte Carlo analysis, and so on. So we had a lot of examples. First of all, if you remember the capital budgeting, we started with the estimation of the NPV using just investment criteria. Then we started with when the cash flows were given. So the first step was this NPV and so on, IRR and all other investment criteria, payback rule, and so on. However, then we said, what if we try to estimate by ourselves the cash flows? If we estimate the cash flow by ourselves, and how can we calculate the NPV in this term? So this is what you learned as well. So we try to estimate the cash flows. Then we learn how to estimate the cash flows using with the different scenarios, if changing the scenario analysis. And we learn how to change in each variable, what will be impact on your NPV itself. And so on. And through from the beginning till the end of this chapter, you learned how to do the investment criteria. So in this case, up to this point, everything we were assuming that it's ceteris paribus, like everything is the same. By everything, I mean the cost of capital, the discount rate that we used in here. We assume it is not changing, like 11, 12%, whatever the case. So discount rate 14, 10, and 12% changing, but it was given estimated, it was calculated. But in this chapter, in the new chapter that we're going to start, which is cost of capital, okay, is all about estimating the discount rate. It's all about estimating required rate of return. So there are many ways to get it, things to estimate the NPV. We'll see it through this chapter, okay? So cost of capital is the cost of using of the funds of the creditors and the owners, creating the value that requires investing in capital project that provide the return greater than the project cost of capital. So when we view the firm as a whole, or where the firm creates the value, when it provides a return which is more than cost of capital. So estimating the cost of capital is a really challenging issue. So we need to take care of estimation because it cannot be observed easily. We must make some number of assumptions in order to estimate the cost of capital. And for a certain project, for a certain given project, the firm's financial manager should take into consideration its cost of capital as well. So cost of capital, simply to say, is the rate of return that the suppliers of the capital, sometimes they are called bondholder or creditors, the one who supplies the money, and the owners of those money, they require as a compensation for their contribution as a capital into a certain project. It can be fixed amount, it can be agreed amount from the profit and so on. So these costs reflect the opportunity cost of the supplier for the capital. And everybody is familiar what does the opportunity cost means. That if you invest in here, your money, you could have invested in somewhere else that could give you some return. So the opportunity cost of investing the money in project A is not putting the money in the bank account or putting the money in the bank account. Okay, so opportunity cost of your coming to the class is to sleep, like you just forgot the sleeping. You come here and you study the corporate finance, or to have a lunch and so on. So the cost of capital is basically the marginal cost, the cost of raising additional capital. So cost of capital is referred to weighted average cost of capital, which is cost of raising additional capital with a weight of representing proportional of each source of financing that is being used. So also this terminology is known as marginal cost of capital, MCC, or WACC. So the formula, if you just open it up, as you can see here, weighted average cost of capital, WD times R&D. So WD is the proportion of the debt. R&D is the rate before the tax. Okay, before you pay the tax. 1 minus T. T is representing the tax itself, the marginal tax rate. Plus WP, RP. WP is the proportion of the preferred stock. If the company has got some preferred stock, we need to take into consideration while estimating the weighted average cost of capital. And RNP is marginal cost of the preferred stock. Plus WE and RE is proportion of equity and marginal cost of the equity, respectively. So this is, if you open up the formulas, that's okay, that's okay. So we've given some example in here, very simple example. Like suppose the widget company has got the capital structure of composed the following. So the capital structure shows how much of the debt and how much of the equity is used to finance the assets. Like 10 to 40, like 10 million of debt used to finance asset, and the remaining is used to finance the equity, which is 40, 10 for 40. So if before the tax cost of debt is 9% and required rate of return on equity is 15% and tax rate is 30%, what is the widget's weighted average cost of capital? So it's just following this formula, proportion times R&D and proportion times of equity times of the cost of equity, addition of the proportion of the cost of debt and proportion times with the cost of debt, that will give you the weighted average cost of capital. So all the information is given here. All the information is given here. So cost of debt is 9%, cost of equity is 15%. Let me make it bigger so that we can. Okay. So first we start with this part. WG is the proportion of debt and so on. So 0.20 times 9%. Who can tell me how did we get this 0.20, even though it's not given in here? Is there any idea? How did we get it?
It's 10 divided by 50.
Very true. Thank you so much. It's 10 divided by 50. As we said, the capital structure represents the proportion of the debt that is used to finance the asset, and the proportion of the equity is used to finance the asset. So we use only $10 to finance the $50 of assets, so which is 10 divided by 50, that gives us 20%, and the remaining will be going to equity side. So 20 to 80. If this is 30, this should be 70. In total, they should come up with 1, with 100%, not more than this, because there is a balance between total asset and equity with the liability side, equity with the debt. So we just substitute everything into the formulation. They come up with this number, with the average, weighted average cost of capital. Okay, that's good. Okay, now we know how can we calculate the discount rate. Okay, imagine I give you the question, this table of parameter. Okay, like this, but I don't give you the required rate of return. So now it's easy to find the required rate of return. Just put this, calculate this weighted. So required rate of return is the same as weighted average cost of capital. So now you can calculate this using this formula. It's pretty straightforward. That's very easy. You just get the numbers, plug it into formula, and get calculated things. So when the widget company raises $1 million of, or $1 of, or euro, whatever the currency is, of capital, it will raise this capital in the proportion of 20 to 80% of equity. And the cost for it will be 13.25%. So interest on debt is tax deductible. Therefore, the cost of debt must be adjusted to reflect this deductibility. So we multiply before the tax of the debt by the factor, which is 1 minus t, to apply the tax effect on the cost of debt. So that's why we've got this equation in the weighted average cost of capital, like cost of debt times 1 minus t. And the payments to owners are not tax deductible. This thing that you should keep in mind. So the weights should reflect how company will raise the additional capital. Ideally, we would like to know the company's target capital structure, which is the capital structure that underlines the company's goal. What is the best and what is the ideal level of the capital structure should be, like 30 to 70, 40 to 60, and so on. So there are some alternatives are given. Why they are given? Because unfortunately, we cannot easily observe the target capital structure for the company. So there sometimes the alternatives are given, like first, you should assess the market value of the company's capital structure components. Then it will help you to assess the capital structure. Second, you should examine the trends of the company's capital structure. And third, use the capital structure of the comparable companies. So do not be so upset. Maybe this lecture will be a bit boring, but from the next lecture and so on, this chapter will get into more calculation. Okay, it's just theory, it explains, but when we get into the practice side, it will help you to understand better and more clearly. So weighted average cost of capital is the marginal cost for additional funds, therefore additional investment. In capital budgeting, we use weighted average cost of capital as adjusted for project specific risk to calculate the net present value. So using the company's overall weighted average cost of capital in evaluation of capital project, that helps us to assume that the project has some similar risk to average project of the company itself. So given this formulation, the cost of the different source of capital. So to find the weighted average cost of capital, there are 3 different ways to estimate. Okay. So to find this proportion of debt and the cost of equity, proportion of the preferred stock, proportion of equity, to find these ingredients of the weighted average cost of capital, we are given 3 ways, 3 different ways. The first one is the cost of through the cost of debt. The second one, cost of equity, and third is cost of common equity. Okay, we're going to use all of them to try to get the things done, to calculate. So cost of debt, if the company has got publicly traded and long-term investment grade debt, so the cost of debt is determined using the yield to maturity. If company has got outstanding debt, that does not trade regularly in the market. So the cost of debt is estimated using the average yield for the similar rated debt. If rating does not exist for a certain company's debt, an estimation of synthetic rating, which is given in the following slides, is used actually, which is risk-free rate plus default spreads approach. And the fourth, the company has got speculative grade debt, which is cost debt calculated using the capital asset pricing model. So the cost of debt is being calculated using YTM approach and debt rating approach. Here, the first example, which is given, that says there's a company that has got 100 million of debt outstanding and has got the coupon rate 5%, 10%, 10 years to the maturity, and which is quoted at 0.98, which is quoted at 0.98. So what is the after-tax cost of debt? If the marginal tax rate is 40%, assume the semi-annual interest rate. So in here, we need to calculate the rate itself, and then we need to apply the tax effect. So we calculate here the YTM, okay? We calculate here the YTM. The face value of the bond is 100, and the bond value itself, which is being credited currently, is 98. So we can use the calculator, we can use the spreadsheet. I mean, more specifically, we can use the financial calculator, or we can use the spreadsheet. I'm going to apply these things all in the example, but not now, but later. So when you use the Excel file spreadsheet, you can get this number easily, the rate 0.5, and you just take the effect of the tax. Then you come up with the after tax, which is here. Cost of debt is here, okay? So the cost of debt and the capital is 3.15 and so on. Consider the company has got the non-traded 100 million of debt and outstanding, and has got the debt of rating of AA. The yield on the AA debt is currently 6.2%. So what is the after-tax cost of debt? So we just apply it using the tax effect as well. 0.062 times 1 minus 40% of the tax. That will come up 3.72% of cost of debt. Synthetic rating approach estimated is alternative way that is giving you opportunity to play the role of rating agency, and that helps you to, that makes you to assign a rating to a certain firm based on financial ratio. So this rating is called actually synthetic rating. To make this assessment, we begin with the rated firms and examine the financial patterns of that shared by firms. So within each rating class. So once synthetic rating is assessed, it can be used to estimate default spread, where added to the risk-free rate yield pre-tax cost of debt for the firm. So the example is given here. So what do you do here? You get the examples of rated firms, and then what you do, just FFO plus expense and so on. So this is done. Actually, there are some formulations that are used, but we're not going to go through this synthetic rating approach. Okay, we'll try to, so you will see when we get into more examples, which is mostly used. This is not mostly used approach, but still it's being used to come up with the cost of debt. Yeah, I'm just skipping this part. Okay, coming to the cost of preferred stock. Coming to the cost of preferred stock. Cost of preferred stock, there is non-callable and non-convertible is based on perpetuity formula, which is dividend over rate for the preferred stock. The preferred itself, it's as a perpetuity that doesn't have any limitation in life. And the problem example is given in here, like the company which has got a preferred stock outstanding and has got dividend of 1.25 per share, and the price of that preferred share is $20. So what is the company's cost preferred equity? It's just straightforward formula. 1.25 divided by 20, that will give you the rate on the preferred share. However, we need to calculate this cost of preferred stock in the case only if the company has got some preferred shares outstanding. If it doesn't have it, we directly assume it's zero. Like the formulation we're given here, okay? This middle part. If the company doesn't have any preferred shares, then we don't need to proceed with the estimation of the proportion and the cost of equity. Sorry, the cost of preferred equity more specifically. Now you know how to calculate the cost of debt. You know how to calculate the cost of preferred equity. Basically, two main approaches which is used to, we're gonna concentrate more on this for the cost of debt is YTM approach and debt rating approach. So these two approaches are used to come up with cost of debt. We know how to use the cost of preferred equity, so which is return on preferred stock, and there is a variation because of the callability itself. Now we are coming to the third part of the formula, which is cost of equity. The proportion is it's directly given by the company itself. You need to know what is the debt and what is the equity used to finance the asset. Your job is to find the cost of debt, cost of preferred equity. Now it's cost of equity, and the cost of equity has been divided into three parts: CAPM, dividend discount model, and bond yield plus risk premium. So these three methods are used to find the cost of equity. And at the end, why we need to know this all? The reason we do this all, like finding cost of debt, cost of equity, or cost of preferred equity, and then we multiply by its proportion, add them up all together, we're going to come up with the weighted average cost of capital, which will be used to estimate certain projects, MPVs, and profitability index, and so on. Okay, coming to the first part of the estimation of the cost of equity through the CAPM model. Capital asset pricing model states that expected return on equity is the sum of risk-free rate of interest and premium for the bearing that market risk that cannot be diversified. So beta, it has got two parts mainly, okay? Risk-free, where there is no risk, you get just certain amount of the money, and there is a risk which is market risk that cannot be diversified, and you get compensated for that. So beta represents the return sensitivity of the stock I to changes in the market returns. Simply to say, it represents the volatility in the market. RM, it represents the expected return on the market. RM minus RF, it's expected market risk premium or equity risk premium, abbreviated as ARP. If risk-free rate is 3%, the market risk premium is 5%. The company has got the beta of 1.2. So what is the company's cost of equity? It's just straightforward. What do you do? Just take the numbers and plug it into the previous formula in the previous slide here and get the cost of equity calculated. So we know how to use the cost of debt. We know how to use the cost of equity, of preferred equity. Now we know how to estimate the cost of common equity through the CAPM. We need to just get the numbers and put it there. But however, I'm sorry. However, there are some cases where you need to calculate beta itself, okay? We need to calculate the beta. We'll come to that point, how to estimate and how to calculate the beta itself. Okay, we know the formula. Let's say risk-free is given. However, the beta is not given. How can we estimate the beta? Then it's another concern that we will talk about as well. Alternatives to the CAPM. Alternatives model may be used to capture the expected return to a risk factor that is not incorporated in the CAPM. So for example, we can use factor model, estimate of the cost of equity. So beta is the stock sensitivity to changes. It represents still like volatility of in the company stocks and expected risk premium. And basically this approach is done through the regression analysis, which you will not be responsible for, just for your information that there are alternatives that can be done. So the second method, the second way of estimation the cost of equity is through DDM, which is dividend discount model. Assume that the value of the stock today is represent the value of all future dividends that will be received. That all these future dividends will be discounted at required rate of return. And this is the formula is given, P0 D1 R minus G. So this is formula we know it like from the finance courses, if you've taken before. So which will help us to rearrange it if you just get this required rate of return on equity to the left side and bring the P0 to the right side and just rearrange the formula, and we get this formulation. Okay, so we can estimate the growth rate by G using the third-party estimates and the company's dividend growth estimation companies as sustainable growth rate. So sustainable growth product return on equity is given here. G is equal 1 minus D divided by EPS and times by return on equity. So retention ratio means in here that how much money is retained in the company and how much money paid as a dividend after the derivation of the net income. So we're given an example here as well. Suppose the gadget company has the current dividend of $2 per share. So the current price of the share gadget company has got is $40, and the gadget company has dividend payout of 20% and expected return equity is 12%. So payout is 20% and retention ratio is equal to 80%. So 20% will be paid as a dividend and the 80% will be kept in the company. So what is the cost of the gadget company common equity here? So using the dividend payout ratio return on equity, we calculate that 1 minus dividend payout ratio, which is 20%, times return on equity, which is 12%. That will give us the growth. Then we will use this growth in estimation of in the estimation of the cost of equity. So we just plug this G calculated as 9.6% into the formula to estimate the cost of equity. So 2 times 1 plus 9.6%, and this all divided by $40. So it's a previous formula which is given here, the one that we rearranged, and plus 1 plus the growth rate itself, and then it will give us 15.08% of cost of equity. So this is the second way. So estimate the cost of common equity. We use CAPM model, the formula that we know it's a risk-free asset plus equity risk premium. We use the DDM model, dividend discount model, applying the sustainable growth rate. And at the end, we use the bond yield plus risk premium. So the bond yield plus risk premium approach requires the adding premium to the company's yield on its debt. So we have cost of debt and plus we're adding the risk premium. That is the approach which is based on the idea that the equity of the company is riskier than the debt. So, but the cost of this source move in one direction. So this is the third approach. The topics in cost of capital estimation is estimating the projects better, estimating country risk premium, and using upward slope in marginal cost of capital schedule and dealing with the fluctuation cost. So project betas, in judgment that is applied in estimation of the company's beta. And as I said, the beta represents the volatility of certain companies. So regarding the estimation period, the periodicity of the return interval and appropriate market index. And the last is the adjustment for the small company stock. If the company is not publicly traded, this is a very big challenging issue. Imagine we are dealing with the company which is not public. For all publicly traded companies, the betas are available. You can easily find it in the website. You can easily calculate the beta. But for all those companies that they are not publicly traded, so in this case, we are estimating the project beta. Then we need to look to the risk company or project using that uses the comparables. So what does the comparable means? Something that can be compared and can be used as an alternative to estimate the betas. So when selecting the comparable for estimation project beta, we ideally would like to find a company with a single line of business. Like if the construction company, let's say Basis, so who can tell me the similar, let's say this Basis company, construction company is being traded in the financial market. However, there's another company which is BI Group, which is not being traded. So for the BI Group to estimate the betas, we're going to use the basis information, the company. So they should be in the same line of business. So this ideal comparable is a pure play methodology. So we use beta of comparable companies to estimate an asset with a beta, then use it for project company. So the steps that you need to follow: first, you select the comparable, then estimate the beta for that comparable, unlever comparable beta to estimate the asset beta, and lever the beta for the project financial risk. So levering and unlevering the beta. To unlever the beta, we remove that comparable's capital structure from the beta to arrive the asset beta. To lever the beta, we adjust the project's financial risk. Okay. I know you might be lost in here, levering and unlevering the betas and so on. When we get into the examples with levering and unlevering, then you will really understand what I mean in here. We'll have some comprehensive examples where we're going to use this estimation for certain projects, special cash flow. Okay, let me skip this project. I will I will come to this a bit later when I finish the chapter. I will come to this, but I want you to pay attention to more to this part, more concentrated, because it's very important, and we need to dedicate maybe 1 hour to explain this unlevering and levering issue, how we derive these formulas itself. So Country risk premium is the additional risk premium that is associated with doing business in developing nation. So additional premium added to the equity risk premium in calculation of the CAPM. So it is the country equity premium, which is here, as you can see it. Upward sloping marginal cost of capital schedule. The marginal cost of the capital schedule may slope upward with a higher cost of raising and more capital. So the point at which the cost of capital changes is the break point. So there may be many break points as well. Applying the cost of capital to capital budgeting and security valuation. Investment opportunity schedule is the representation of the return on investment. So investment opportunity schedule is downward sloping. The more company invests, the lower the additional opportunities. So that is, the company will invest in high return, in the highest returning investments first, and then they will be followed by the lower yielding investments, as it goes normally in the financial market. So marginal cost of capital schedule is representation of the cost of raising additional funds, like is, as we said, is similarly used as weighted average cost of capital. So we generally assume that marginal cost of capital is upward sloping. More funds company raises, the greater the cost will be. Cost or return. And the optimal point where they intersect. So this is where they will be satisfied. If you remember from economics courses, the marginal cost and the marginal benefit. The best point will be the intersection point, the point of the equilibrium. Flotation cost is the cost where the investment banking fee associated with issuing securities. To treat the flotation costs accurately, adjust the NPV for the project monetary cost of flotation. So problem is given here as an example, like a project has got the NPV of 100 million and the company issues 1 billion of equity to finance the project, where the flotation costs are 1.2%. And what is the NPV after adjustment of the flotation cost? So the solution is here. 100 million minus the flotation cost itself. If it's positive, then you can just run the project itself. You have any questions? You will get better idea of these things, but in this chapter, I want you to pay more attention to the structure, okay? This structure. This is all about the whole chapter. You know, you have to know how to calculate the cost of debt using the two ways. You know how to calculate the cost of preferred equity, and you should know how to calculate the cost of common equity. Sometimes there are companies, if it's companies that are not traded publicly, then directly your preferred stock will be zero. So the middle component, middle ingredients will be zero. So you have to pay attention more than to cost of debt and cost of equity. So to find out the cost of capital, you can do it through the cost. You can do through this formula. You need to find proportions. Is easy to find it. Sometimes the proportion is given as a target capital structure, which is, let's say, 30 or something on. We'll have the examples and you'll get better of it. And your job is to estimate cost of debt, cost of preferred equity, and cost of common equity through different approaches. If you're using the CAPM approach, better for CAPM approach is given if the company is traded publicly. But if the company which is not traded publicly, then you should put a bit effort to find it the better. And to find the better, which better I mean, here, the better I'm talking here. In a publicly traded company, all the betters are available. So it's easy to put it and just calculate it. But if it's not available, then you're using the pure play methodology, which is you're selecting comparables. Okay. Here, you select the comparable, estimate the beta for comparable, unlever, then lever it. then you'll be able to find the beta. So this is how it works. Okay. When we get into the example, we'll have better understanding. But now, let me take the attendance. And then if you have any questions, you can ask. Sanjar is here. Islam?
I'm here.
Great. Aiday?
I'm here.
Yasmin?
I'm here.
Jean? Jean Amangeldi here. Okay. Niyaz?
I'm here.
Tamiris?
I'm here.
Yerzat?
Here.
Kaplugani?
I'm here.
Raushan?
I'm here.
Inura? Aidana? Begzat?
I'm here.
Zirui? Zirui here? No.
Yes, I'm here.
Okay, Zirui, you're here. Sultan? Daujan?
I'm here.
Eldar?
I'm here.
Aydos? Gani? Artur? Gaziz?
I'm here.
Okay, Artur is not here. Gaziz is here.
Sorry, Professor. Amangeldijan is here. I didn't hear you.
Which Aman geldi?
Amangeldijan.
Where have you been?
I think seventh.
No, I mean, where have you been when I was calling you?
My microphone didn't work.
Okay.
Professor, sorry, Arnold Ture is also here. I have bad connection. I'm not in city.
Okay, Arthur, where are you?
Arnold Ture.
Arnold Ture, I'm sorry.
Here.
Okay, okay.
Thank you.
Ilya?
Here.
Daniel?
I'm here.
Vladislav?
I'm here.
Diana?
Here.
Clementi?
I'm here.
Janelle? Janelle here? No. Camila? And Adil Khan?
I'm here, Professor.
Okay.
Excuse me, Professor.
Yes, just a second. I'm here. You cannot hear me. Wait, Zarina, where are you? I put you on already. You're
Okay,
here.
thank you.
I saw you.
Baglam is also here.
Yeah, I know. I saw you guys. Those names that I didn't call, you're here. Abdurrahim? I think I missed this part. Gani, Artur, Baglan, here, Zarina here, Abdurrahim, no here, Raihan,
I'm here.
Raihan here, Alibek,
I'm here.
Danyar,
I'm here.
Danyar here, Sanjana,
I'm here.
Baglan, Milana,
Here.
okay, and Arnur, Ilya, and so on. Okay. I'm done for today. Thank you so much. I will see you on Wednesday.
Thank you. Bye.
Bye.
Thank you. Goodbye.
Thank you. Goodbye.
Goodbye.
Bye.
Have a nice studying. Have a nice preparation. Please feel free to contact me if you have any questions.
Professor,
Yes.
Thank you, Professor. Have a nice day.
sorry, will we have our exams through Moodle or will you send us?
No, no, no. It will be through the Moodle. 10 multiple choices and 1 open-end questions.
Will we write open-ended question to Excel sheet or? Well,
Any you want. You can write it manually. You can write
Ah.
it Excel spreadsheet, but then you have to submit it, upload it to the Moodle.
okay. Thank you.
May I ask
Bye,
also
Professor.
about the multiple choice questions?
Yes,
Is it
sure.
all about theory or calculations as we had in quiz?
End of the chapter. All
Oh,
the
just like-
questions,
Okay.
all the questions at the end of the chapter.
Okay. Thank you.
Thank you. Goodbye.